The interest rate you get for your home loan or mortgage can make the difference between paying a reasonable amount or paying thousands of dollars too much. Interest rates can fluctuate, so understanding how they affect your mortgage is essential to getting the best deal. If you don't want to pay through the nose on your loan, then this is the video for you. I'm Kim, and we're going to talk about exactly how your interest rate affects your loan and what it means to your bottom line and monthly payments. Let's look at an example. If you were going to buy a house priced at $320,000 and you were going to put in a down payment of $20,000, then you would need a $300,000 loan. But how does your interest rate on that loan affect your monthly payment? Well, let's say you have an annual percentage rate of 4%. In the very first month of your loan payment, they'll multiply your interest rate by the amount of your loan. If you have $300,000 and you multiply that number by 4%, it gives you $12,000. This is an annual rate, so that amount is divided by 12 months, which equals $1,000. So when you make a payment on this house for the first time, they get $1,000 in interest. Now, what makes this tricky is that there is also some money going toward the loan's principal, or the actual loan amount. Using a rate of 4%, the amount used for the principal in this situation works out to $432. So $1,000 is going toward the interest and $432 is going toward the principal. The amount you owe will go down by only $432. So the new amount you owe will be $299,568. So what do they do for the next month? Well, they now use your new balance to figure out the change in your interest and principal due. As you can imagine, the amount of interest is still quite high, and the amount you are paying towards principal doesn't go up by very much. But what's interesting is that the amount of interest and the amount of principal that were in the first payment always add up to the same number. This means you pay the same monthly rate throughout the life of your loan, which in this case is $1,432. So, since your interest rate is slowly, and I mean slowly, going down, your principal is also very slightly going up. Even the last payment you make in this 30-year period will be $5 toward your interest and $1,427 toward your principal. So, now that you understand how it works, let's look at 3 examples. Okay, we'll still use $300,000 as a loan amount, but I want to explain the difference between a 3% interest rate, a 4% interest rate, and a 5% interest rate. So all of these things will always add up to the same thing. You're gonna pay back the $300,000 you borrowed in the first place. That will always be the case. Because you borrowed $300,000, that will never change. But what difference does that one thing really make? Well, if you lived in the house for 30 years and the interest rate was 5%, you would have paid more than $279,000 or $767 in interest, meaning that you paid a total of $579,767. Yes, it's twice as much. Hey Kim, I thought we were only talking about 5%, not 50%. Well, it's true, and the number is 5%. I found out that the number that would make me pay $300,000 in interest is 5.31%. In fact, $300,400 and $600,400 all together. 5% is what we're talking about. The monthly payment is about $1,610.46, as you can see. Now, this is just a matter of the principal and the interest. It doesn't cover taxes, insurance, and other things. So here's what I find when I look at interest of 4%. The monthly payment drops to $143, which isn't too bad. With an interest rate of 5%, would that be less than $178 a month? You are paying almost $200, which isn't too bad. But you're noticing that the total interest rate goes down by a lot. If my math is right, that 1 point of interest is saving you $64,000. If you live in this house for 30 years, $64,000 is a lot of money. Last but not least, at 3%, the monthly payment drops to $1,264.81, and the total interest rate drops to $155,332. This saves you about $60,000 in interest payments and just under $200 in monthly payments. Yes, we are talking about a difference of about $120,000 over the life of the loan you gave the lender because of those 2 points of interest. And this is what we usually see when we talk about things like help with a down payment. Most of the time, I think it will be 1 or 2 points higher. I know what you're thinking. We're all young people here. We don't like to think about what will happen in 30 years. Or you might say to yourself, hey, I'm gonna sell a house anyway. But let's say you stay in your house for 30 years. Do you think that having an extra $120,000 in your bank account would make a difference? So I think that's the most important change. It's actually number 1 and 2. But let's just say, number 1, that when it's all said and done in 30 years, you'll pay a lot more for the difference. With just 1 point of interest, you're likely to pay about $60,000 more over the life of the loan. The second thing I was talking about was that the monthly payment would go down, maybe by $200 or $300, depending on the situation. But in this case, it's about the difference, which is almost $200. So the second thing I was curious about was how much I was paying on the percentage, which is like a ratio of interest to principal. What do you mean by ratio, Kim? Well, since the number didn't change, we can figure out how much of the payment goes to interest and how much to the balance. When I first looked at the 5% number, I thought these two things were true. You always pay the same amount per month as per year. For example, the monthly payment for a $300,000 loan with a 5% interest rate is always $1,610. And because that's true, every year will always look the same, whether it's the first year or the 30th year. The interest rate and the amount you owe will be the only things that change. So I was interested in seeing what the ratio looks like at 5% and what the difference is between 3% and 4%. Well, at 5% per year, I'm looking at it on an annual basis, not a monthly one. So 77% of the total amount we paid that year went to the interest rate. Basically, almost 80% of what you pay on your mortgage goes straight to interest. And that's pretty sad, because you have to pay a lot of money in interest, which stinks. But I wanted to know if that number or percentage ratio would change if my interest rate went down. Well, look at this. At 4% interest, I saw 2 changes in this situation. I've seen that the amount you pay every month that doesn't change goes down. So I'm paying $1,432.25 instead of $1,610.46. And that number never changes. Because of this, my yearly number also changes. So not only do I have to find less money every month, but I also have to find less money every year. So when we compare the ratio of the first year to 5%, which is 77% to 22%, we see a small difference. In the first year, I put 69% of my payments toward the interest and 30 or 31% toward the principal. So almost 10% more of my payment goes toward paying down the principal. I'm not only paying less in interest, but I'm also putting more of my first payment toward my principal. And by the way, it's worth noting that in both cases, as I live in the house every month, it does start to go down very slightly. About 1% of the time, it changes every year. So, if it's a 4% number, for example, it goes to 69.31. Then, in year 2, it goes down to 68%. In year 3, it goes down to 66%. And on average, it keeps going down between 1 and 2% each year. Now we'll look at the last part, which is our 3%. We saw that the amount you have to pay each month is going to be a lot less, around $200. So the amount paid each year is also a lot less. We know that if the interest rate is lower, you pay less. But what's really strange is that the amount that goes to interest and principal in the first year is about 10% less than 4%. So first, 59% of your monthly payment goes toward interest and 41% goes toward paying off the principal. I don't know about you, but when I make my monthly payment, it's nice to know that 80% of it isn't going to interest, which is basically money that they're making on their loan and giving to their investors, or whatever the case may be. Understanding how your interest rate affects your mortgage, and especially the speed with which you can pay off your principal loan, can mean thousands of dollars saved. This is really important stuff. And now that you're armed with some knowledge, you can start making some better decisions to get you closer to your financial goals. Of course, if you want the best interest rates on your loans, then having a solid credit score is essential. The better your score, the better your available rates. So next, be sure to watch this video where I break down all the details about what a credit score is and how it is determined. See you there!